let's pivot now to China. I want to talk about what's happening over in the Chinese economy. Now, we had the reopening of the Chinese economy post their COVID lockdowns sort of 6-8 months ago. And, you know, that provided a bit of a stimulatory environment for a period of time, but it's been a bit underwhelming. The other thing to talk about here is the Chinese central bank cutting the amount of money the country's lenders are required to hold in reserve in a bid to keep cash flowing through the economy. What are your thoughts on the current state of play in China, Jonathan?
Eugene, I'm spending an enormous amount of my time on China. As you know, I've studied China for more than 3 decades. And I think it was about 2 years ago that I said I've never been so negative on China in all the 30 years that I've studied it. And that observation 2 years ago was driven by my anxiety, my concern around the Chinese property market. And 2 years ago, of course, we saw the spectacular default by China's then largest property developer, Evergrande. And today, and in the last few weeks, all of us who watch China closely have been mesmerized by what's happening with Country Garden, which then became the largest property developer in China. And we've seen Country Garden's bond prices in the secondary market completely collapse. We've seen its share price listed in Hong Kong completely collapse. I mean, just to give you some round numbers, Country Garden 2 years ago as a share price was trading around 12 Hong Kong dollars, and it's now trading below 1 Hong Kong dollar. So that gives you the extent of it. Country Garden also failed to pay 2 interest payments on 2 of its onshore bonds at the beginning of last week. The economy now is officially in deflation. We saw consumer price inflation in China reported last week and declining on a year-on-year rate of -0.3. So we actually have an official deflation in headline CPI. And obviously producer prices have been negative year-on-year now for several months. So what on earth is happening? My view, and I've expressed this endlessly in my pain report for the last couple of years, in fact, is that we've seen the bursting of an epic property bubble in China. I've also written extensively about my belief that China, to me today, feels a lot like Japan did in the early 90s. We've got youth unemployment in China at 21.3%. Youth unemployment, 21.3%. We have seen, of course, deflation recently. We're seeing further evidence of a precipitous decline in land sales, in apartment sales. So if we believe the property bubble in China has finally burst, that has significant ramifications for the overall economy. Why? Because property, if you add together all of the contribution that property makes to the overall economy, estimates are between 20 to 25% of Chinese economic growth is driven by the property sector or companies related or servicing the property sector. So that's a big chunk of the pie. And what is surprising all of us is the hesitancy by Beijing to stimulate the property sector. But just remember this, Eugene, this is really important for us to remember that coming into this much weaker property environment was the continued concern by the authorities in Beijing and for several years now that there was simply too much debt. And talking about too much debt, in the last few weeks, we've seen what we call local government financing vehicles. So local governments in China have for decades, obviously, basically derived most of their revenue out of land sales. And obviously land sales have been declining. And so unfortunately, we've now got a spotlight on so-called local government debt in China as well. So this is a fast-moving situation, but my bottom line is that China now is not going to provide the kind of engine of growth for the global economy that we've seen over the last decade. And just to finish this conversation around China, China's contribution to the growth in the global economy over the last decade is 40%. So 40% of the growth in the global economy has been driven by China's growth. So the United States is about 20% of global growth over the last decade, and the Eurozone in its entirety is around and about 10%. So let's be very clear that what is happening in China does not stay in China. I mean, and that's important. So, yeah, I mean, I'd love to continue the conversation on China if you wish.
Sure. I mean, yeah, you could talk for a long time about China on its own, and that there are some staggering numbers. Over the years, whenever there's been a global crisis, well, particularly in the last sort of 15 years, we've been able to rely on growth coming out of China to help stimulate the rest of the world. In some ways, one could consider that what happens in China is probably more painful for the rest of the world than it actually is for China in some respects. But I think it's also very interesting that you say that China is actually in a deflationary environment. Let's not call it a spiral yet. When the rest of the world is either still trying to get inflation under control or in a disinflationary type environment. So that's all very interesting. And look, we've talked about the flow-on effects for the rest of the world from China's, potential slowdown. What about Australia? I mean, China is one of our biggest trading partners, perhaps less so in the last few years, but historically it's been one of our biggest trading partners here in Australia. Can we talk a little bit about how this slowdown in China might impact the Australian economy, the Australian share market, and then maybe touch on what you're thinking in terms of the local economy and markets in Australia?
Yeah, as you say, Eugene, Australia has been one of the greatest beneficiaries of this remarkable economic miracle that all of us have been witness to in China in the last 20 years plus. You might remember in 2003, Eugene, I used to say that China's a sleeping giant and it's awoken. And I used to also say the most significant and defining economic phenomenon of our time is the rise of the Asian middle classes, for they will shape and define the topography of the global economic landscape for decades. And that was 20 years ago. And let me just be very clear. The growth in the Asian middle classes is still an incredibly powerful economic phenomenon. So let me make that very clear. And there are other countries in Asia that I have been very, very positive about and will continue to be positive about, namely Indonesia, India, and Vietnam, spectacularly successful economy. So I just want to place our conversation in that context. My concerns about China today are that it has grown arguably too fast, too quickly. The debt levels are very, very high, and we're now beginning to see the property market unravel, and that will slow growth. Consequences of that will be that countries that export a lot to China, and we are in pole position in that regard, will clearly see a decline in the demand for our exports, principally iron ore, because that feeds through into infrastructure and property development in China. So what are the consequences for Australia? Clearly, if China slows, and I believe it will continue to do so, that will have a net negative impact on the Australian economy.